Thank you very much. And thank you to Bambina and also to Rick for hosting today's session. It's a real honor to be invited to speak to you all. Listen, the theme of this the session today is looking beyond the pandemic and how the world will look, at least from a real estate perspective, after the virus has been beaten. But I just first want to touch on the pandemic itself, because ultimately our timing comes down to that process of defeating the virus. There is the reality that the virus isn't yet beaten. There is a glimmer of hope. I noted that the numbers of cases globally hit an all-time high on the 27th of April, and from there's been a slight decline over the past few days. The vaccine rollout has surprised on the upside in terms of the effectiveness of the various vaccines which are being used globally, delivering more than we probably hoped for even a year ago. The challenge ultimately comes down to delivery and production of the vaccines, and most economists are looking at 2022, 2023 as the best estimate for when global vaccination will either be completed or at least largely complete. So at a global level, the themes that we're talking about today will be impacting some markets now and certainly over the next few months. So places like the UK and the US, slightly later in Europe, and then rolling out into Asia and elsewhere from there. We've already got the benefit of lessons from those countries which either locked down and managed the virus very well, or that they've had very strong vaccination programs like Israel, etc. So there are lessons that we can take from the global property market to help us understand where things may be moving. As Rick said at the outset, I'm going to discuss the global property market through the lens of the Knight Frank Wealth Report. Now, this was published back in March. And for the last 15 years, the report has assessed the impact of private capital on property market performance. And the reason for doing this is because what we've been analysing over the past 15 years is how closely private wealth has become critical to the performance of commercial and also obviously residential markets at a global level. Nearly a third of all global property investment is now driven by wealthy or affluent individuals, either direct purchases or through their companies. So an understanding of the behaviors and the attitudes of the wealthy is fundamental to an understanding of global property market trends. So over the next 10 minutes, I'm going to discuss the future of global property markets. I'm going to focus on 5 key themes from this year's report. And beyond the headlines that I'm going to share with you, there's a huge amount of data and information and insight in the report that you can delve into and investigate market opportunities in more detail. So I'll move on to my first theme, if I can, on my slide deck. Let's think about the global policy response to the pandemic. And it's rather similar to the story after the global financial crisis, in that we've had lower interest rates, more fiscal stimulus, and it means that asset prices have surged around the world. In fact, our wealth sizing model inside the wealth report confirms that the world's ultra high net worth population rose by about 2.4% last year to more than 520,000 individuals. And that process was seen in most parts of the world, across North America and Europe. But it was Asia, with 12% growth in a single year, that saw the real upswing. And this is one of the key narratives that we explore in the report, that the US is, without doubt, the world's dominant wealth hub. But over our forecast period, Asia is likely to see the fastest growth in ultra high net worth populations, well above the global average. And actually, by 2025, Asia will host nearly a quarter of all ultra high net worth individuals, up from 17% only a decade ago. And the region's already home to more billionaires than any other. A second theme we touch on is how actually that growth in wealth through the pandemic actually provides a risk to future wealth creation. So nearly half of our attitude survey respondents in this year's report confirm that the growth in wealth inequality is expected to lead to demands or increased demands for policies aimed at curbing that imbalance. So over the past 6 months, We've seen new or proposed plans in places like Argentina, Canada, South Korea for wealth taxes, and it's a key part of the tax discussion in the US under the Biden administration as well. Moving on to my second theme, how has the pandemic impacted on cities? Urban centres, particularly in locations like Europe and the US, appeared to be a major casualty from the pandemic. So wealthy residents were reported to be leaving cities. Central business districts have stood empty, and retailers have stared into the abyss as many of their markets have been locked down. But against this backdrop, we've taken a deliberately positive view of cities. There's no doubt that the wealthy have been favouring, certainly in Western economies, country property or suburban property over city property. But there's also a counterpoint here. Our data for London shows that we've hit a record high in the numbers of people, so London-based buyers who are not sellers, i.e. the surge for, say, suburban or country homes reflects a growth in housing consumption. There's likely to be more second homeowners in affluent markets at the end of the pandemic than at the beginning of the pandemic. And I'll see in a moment actually how changes to working patterns and the use of the office opens the opportunity for redevelopment and regeneration. And one of our key findings really from the report is that the pandemic, far from undermining the city, has shown the potential for rebirth. And it's striking that when we asked in our attitude survey which property sectors were most in demand amongst wealthy investors, development opportunities moved into third place, showing that wealthy investors are increasingly attracted to the opportunity to be involved in remodeling and reshaping cities after the pandemic. So on to my third theme, prime residential property. It's a cornerstone of the report. Kate Everett-Allen, our head of international research, who edits this section of the report, she confirms that house prices rose through the pandemic because of the pandemic, not despite it. So a combination of themes, low mortgage rates, a search for space and changing commuting patterns all help to push prices higher. In addition, the pandemic-induced boom that we saw is likely to continue this year. Our attitude survey reveals that 26% of global ultra-high net worth individuals are planning to buy a new home in 2021. And it's worth considering this issue in more detail. For example, in the US, prices of houses have increased by 11% over the past year. It's the strongest growth in 15 years. In New Zealand, prices are up 22%, and average global prices are up by their fastest rate in a decade. Now, why is this the case? Well, house prices have been boosted by low interest rates, by fiscal stimulus, as I mentioned, but you've also had high savings rates in many economies. Saving rates have increased by 50% during the pandemic, leading to increased deposit funds. Borrowing costs have also rarely been cheaper than they are at the current time. And you've also seen that shift in demand away from big cities towards housing in less crowded environments. The response to this is that governments are looking to control what they see as exuberance in the marketplace. So in New Zealand, you're already seeing moves to include housing prices and house values in the calculation of central bank policy decisions. And in a growing number of locations globally, including Spain, looking at a rental control policy as a way to mitigate the impact of rising property values. Against this, actually, the fact that in many locations, the reality is that mortgage debt and mortgage payment costs are actually at historically low levels, and bank positions are actually stronger than they were during the last financial crisis. One of the key issues that we see, and we've mentioned in our report, is actually the need for governments to increase opportunities for house building and also for allowing access to people and also in terms of co-living accommodation. On to my fourth topic. The pandemic has disrupted commercial real estate in a significant way at a global level. And this is an area we focus at in real detail in this year's report, despite the fact that overall property investment volumes fell last year, unsurprisingly. the capital deployed by private investors was still 9% above the 10-year average, far stronger than the 6% fall that we saw from institutional investors. And that trend is set to continue through 2021, with a quarter of ultra high net worth individuals planning to invest this year. And a key area of focus in the Wealth Report is how the pandemic is driving real estate innovation. So we've tracked where private wealth has been invested, but we've also assessed how the COVID crisis has accelerated market trends, opening new opportunities. One of the key areas, obviously, is the office market. Office demand is likely to decline in the near term, but probably less than initially expected. A recent European study suggested only 17% of chief executives expect to cut office space in the next 3 years, down from nearly 70% in the same survey 6 months earlier. So there's been a huge shift in the attitudes of office occupiers as to how they will be using space in the long run. And actually more companies are thinking about work from home as a potential opportunity to attract employees. But in reality, even this particular story is shifting right now. JP Morgan commented that 10% of their global employee base may work from home full time, but the vast majority will be expected to be coming back into the office. And there'll be many more announcements recently. Rents in the office market will be under pressure. There's no doubt that there is a significant issue at the moment around releasing of space, but we see increasingly in many developed markets a divide in the marketplace is occurring. High quality, the best quality office space, which aligns with future working habits, is very much in short supply. And at the same time, there is a significant lack of supply of green or BREEAM excellent buildings, the types of buildings that are in demand by office occupiers and corporates right now as they try to fulfill their ESG obligations. But rents are likely to decline, in some cases quite significantly, in older, poorer quality workspaces. But these themselves offer opportunities for redevelopment and for regeneration. There are other spin-offs from this. The range of places to work will widen, or is increasingly set to widen. It may be that actually there will be that divide between working from home and working from the office, but there will also be a demand for alternatives. And one of the areas that the industry is looking at is hospitality. But actually the hospitality sector, particularly hotels, are ideally well placed to provide that alternative third location between working from home and working from the office, and something which we expect to see develop over the next few years. Just thinking about other sectors, the retail sector has seen significant disruption through the pandemic. Retail stores have found themselves to be at a fundamental disadvantage, obviously, to online during lockdowns, but also in terms of the acceleration of an existing trend. Retail stores not only suffer compared to online in terms of pricing and delivery, but the scale of choice that websites can offer is vastly greater than that's offered by retail space. And actually the shift in rents in developed markets, that we've seen rent falls of say 10, 20% in some locations, and even up to 30% in some markets, are again entirely explicable when we think about the impact of lockdowns and of COVID. However, again, set against that, it isn't a single line narrative. That mix of online and in-store sales is something which is beginning to prove to be a winning model. And for example, Amazon itself could eventually have over 4,000 stores globally. We're seeing more of a rollout of concepts from Amazon right now. And what's driving Amazon's move into retail, into physical retail stores, is actually a cost-effective way of delivering the three most important things that retail does. Firstly, acquiring customers. Secondly, getting goods to customers. And then thirdly, building brand awareness. The problem, of course, is that we'll need many more Amazons to actually stabilize demand in the retail space and also occupancy. In terms of logistics, even a market as mature as, say, the UK logistics market has got room to grow. And the expectation is over the next 4 years, there'll be a growth in online retail in the UK and European markets of well over 25%, possibly up to 50% in some southern European markets. And the same story has been played out globally. Despite a huge building boom of logistics space over the past decade, and we've seen a record amount of warehouse space built at a global level, the demand is only increasing, and rents are expected to increase significantly over the next 5 years as demand for online shopping and online delivery continues apace. My final theme I will just touch on briefly is luxury investments. So the image on your screen comes from the photographer that we use in this year's report, who is selling his photographs from galleries across the UK, Europe, and the US, and increasingly from Asia as well, finding a ready demand from investors looking for unique assets. So a key component of the wealth report is our ability to take a wide view of the wealth portfolio. So over recent years, we've developed our Knight Frank Luxury Investment Index, and that tracks not only the performance of luxury collectibles, but it also confirms how the search for returns in a low inflationary world has led to a growing demand for asset classes at a global level. And we see in this year's report how this search for returns is driving one-off sales. And for example, we report on the sale of a T-Rex skeleton to a collector in October of last year in New York at a record-breaking price of $32 million, alongside some other significant one-off sales, but again showing the demand from investors to try to benefit from diversification and searching for returns in a low inflationary environment. Across the whole of the luxury assets that we cover, collectible handbags surprised on the upside, up 17%, but actually a sector of the market which pioneered online auctions, helping liquidity even during lockdowns. Other sectors to see strong performance was fine wine, classic cars, but as physical auctions were put on hold, the art market itself saw values fall by about 11% over the course of the past 12 months. It's a whistle-stop tour of the content of the report, but hopefully gives you some ideas for the question session. In summary, we've seen a growth in wealth through the pandemic, really in response to government policy measures, a growth in asset prices due to falls in interest rates and continued stimulus measures, an expansion in demand for luxury housing at a global level, a polarizing office market at the current time, a rapid retail evolution with opportunities in best in class, but also a strong opportunity there for logistics and other emerging sectors that I haven't had a chance to touch on. That's it from me. I'm going to pass you back to Rick for his presentation. Thank you.